All right, shares of Snap, the parent company of Snapchat, falling again today. They're now about 20% down from their opening price with the close of the first day. Facebook shares, though, also remember plunged shortly after the IPO and then, of course, just took off for a number of years. Could Snap do the same? Fall and then rise? Let's ask the Trading Nation team, which is, he's so good, there's one of them today. Max Wolf with 55 Capital. Max, you're the bull and the bear on this. I'm kidding. Facebook took a dive. Everyone criticized the IPO. Then it took off for a number of years. Do you feel like Snap could do the same?
It's possible. I'm actually one of the few people who did criticize the $38 price target back in 2012 when they went public, went all the way down to 17, and of course now over 100. So I do think this is a good company. I do think it has a bright future. Half of the millennial community is checking in every day, often about 14, 15 times a day. That being said, they're asking for an enterprise value of about 20 times next year's revenue while losing $500 million a year. All this is a kind of return flight back to reality here. Anyone who had their valuation set in the 14, 15 milk and honey days of Web 2.0 startups probably is going to have a little bit of trouble just sort of getting used to the realities of being a public company. Like the company, it's still a little expensive here, but not anywhere near as expensive as it was at the end of the first day, that's for sure.
But what about the compliance structure? You have no voting rights. And here's the thing. I've talked to people, I'm sure we all have, who have said, you know what? I don't want to own the stock. A, I don't have a vote, but B, I don't have that floor of private equity or an activist coming in because there's nothing anybody can do. There's not that sort of automatic price where someone might come in and shake things up or maybe try to buy them, you know, in a hostile bid. It's not going to be possible.
Yeah, so the three big things they did sort of wrong on the IPO are hurting them too. One is they hyped it, they went for too much money right away. They also didn't sell that much of the company so they could have a low float IPO and push the prices up. They also sold more than had been anticipated with some insider selling into the IPO, and they also stripped the voting rights. So they sort of wanted a better for them type of structure, and they wanted a premium, not a discount against that. That's what I mean about sort of the realities of Web 2.0 adjusting to the realities of public company. Still like the company, all those problems are real. But the big problem is they're asking people to pay too much for what's still an experiment because there's no positive earning flow yet.
Come on, if you use the cat filter, Max, I mean, that's $20 billion in value right there, right there. Max Wolf, 55 Capital, thank you very much. For more Trading Nation, go to our website, tradingnation.cnbc.com.
Profits are great, but deciding when to take profits can be very stressful. So to help take the emotion out of a trade, consider scaling out of a winning position. For example, one could sell half of their position for a profit and then use a stop order on the remaining shares.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.